All right, good evening. It's Wednesday, the 27th of April, and this is the Stage Analysis Members Midweek video. So we're going to start off with the free section tonight, which is going to be the earnings review of the mega caps before getting on to the members only content after that, where I'm going to go through the Q2 of the presidential cycle in the midterm year. It's a known weak spot, as well as obviously our usual coverage of the indexes, market breadth data, and then I'm going to have a look through the Wyckoff distributional structures with the events and phases, and have a look at some current potential examples in real time to see what's going on in the market at the moment, as there's a lot more distributional structures than accumulation structures at the moment. So I thought it'd be a good point to cover, and then finally finish off with some of the watch list stocks today, which there's not a huge amount on the long side at the moment, so it's more on the short side at the moment. But okay, let's begin. So starting off tonight, with earnings today, we had Facebook and PayPal were the two large caps reporting tonight. If we go back to the earnings whispers tweet from earlier in the week, I think this was posted at the weekend. This is quite useful if you follow earnings whispers on Twitter. So really good website in terms of looking at the earnings data and what's coming up. It's got an excellent calendar, but they tweet out each week as well the top ones for the days going ahead. So this is a good little guide. So starting off with Monday, we had Coke, for example, Activision Blizzard, and then Microsoft Tuesday and Google were the two big ones, and then today Facebook and PayPal, the two big ones we've been watching today mostly, and then Apple tomorrow, Amazon and Caterpillar, and then Exxon Mobil. So I'm going to cover a couple of these going forward now. So starting with Facebook, had a really strong reaction to its earnings results so far. So it came out, closed today down around the 175 area. So it's had a 18% rally since then. So this is the intraday chart, the 2-hour chart that I use that you can perform stage analysis on. So for example, you can see a stage 1 base, little mini stage 1 base over here. I'm not sure why that's gone orange. But and then obviously stage 3 top area at the top here before breaking down into stage 4. So potentially we've got a little short-term selling climax in here, an automatic rally. So if we zoom it out on this and go to the weekly chart, you can see this is in what we call late stage 4B. So it's extremely deep into its stage 4 decline. So it started to break down into stage 4 a long time ago. So back in earnings results back in January at this point here, you can see the stage 3 top that formed from the initial high up here. This was our change of behavior area, which then initially starts the stage 3 range, but then it formed this lower base structure, which in here before rolling over on the earnings and pulling down. And then we've been starting to form a little structure down here, which is undercut, and now with today's pop, we'll be popping back up to around the 210 area at the moment. So potentially starting to form an initial base structure in here, but it's a long way below the 30-week moving average here. You can see the moving average is still got a long ways to go before it starts to turn back up and out. So it would need a big move to get back up there. So at the moment, you can see we're still from today up to there. So 56% move from where it closed today back up until the 30-week moving average. So even if this has a huge move, it's unlikely to make it back into stage 1 anytime soon. So with these kind of deep stage 4 declines like this, you tend to need a long time for them to base. So when something has come off as much as this, you can see it's actually Facebook has come off over 50%. It tends to need at least a bare minimum is with the stage analysis method is a 6-month base with a decent sized stage 4 decline. But ideally with this kind of one, it's going to need a year or more. So it's already started to base back in February time there. So mark this as our obviously initial low area. So potentially this could be the start of an early stage one base, and we're just potentially moving into phase B of a stage one base. So it could need a whole lot more time to develop, and could just be redistribution, and could easily roll over here again with the market being so weak at the moment. So this could actually be a good short at this point with the gap up move today. Could easily roll over again tomorrow. Looking at PayPal on the intraday chart here. So this is the after hours data included. So not much of a pop going on in the PayPal chart. You can see closed. Where was our close down here? So had an initial pop of around 6%, but it's pulled back in now, only up about 3% after hours now. So not a big move for PayPal by any means. And as we can see, it's in an even deeper stage 4 decline than we saw with Facebook there. So I see some people when they see a chart like this, and they talk about the ideal entry point from stage analysis, and the chart that was posted in the book, where we obviously had a big up and down type move. But with this kind of chart, as I just said, it's when you have a huge stage 4 decline like this. So you can see with the likes of PayPal here, this has come off over 70%. As I said, it's going to need more than a year or so to potentially make it back into stage 2. It could easily have a huge rally. Stage 1 bases can have moves of well over 100%. So you can see it's 95% back up until the 30-week moving average at the moment. So even with a 95% move, it would potentially only just be moving up towards early stage 1, and would potentially need to then form a much larger base structure before potentially moving off into stage 2. So this one has got a long way to go until it could potentially get back into a stage 2 advancing phase, but obviously could be tradable within the stage 1 base if it can start to form a base structure. But at the moment, it remains in late stage 4B, which is a no-go area in the stage analysis method. Okay, next up we've got Apple, which is coming up tomorrow after the close. So this, as we can see, has been making a structure for the last 3 months or so. It's had a few signs of weakness at the bottom of the structure, and it undercut the 200-day moving average, and a little spring type action in here before moving back up towards the top. And we've had an up thrust and a test before a lower high in here. So potential last point of supply at the moment as this forms in stage 3. We had the change of behavior here where it started to move into stage 3. So if we come out of this and go into a weekly chart, you can see the developing stage 3 structure on this. So since the top here, so we're now getting close towards the bottom of the structure, and you can see we've made a lower high and a little up thrust within the structure. So it potentially is getting weaker here. So earnings could actually send this down into stage 4. So if we do get a bad reaction to earnings and it starts to break to the downside here, and then you start to see the 30-week moving average start to roll over, then we could potentially have a stage 4 breakdown. We'd want to see stronger volume on that. Amazon also reporting tomorrow after the bell, I believe. Let me just quickly have a look. 28th, yeah, after the market close. So again, similar sort of structure to what we're seeing in Apple. You can see the local selling climax, the automatic rally, secondary testing, and undercut with a secondary test at the low there for making an up thrust and a test at the 200-day moving average, and then rolling over again, lower high. So potential last point of supply, and then testing the back at the bottom of the range. So this could obviously make a breakdown attempt, which could then, again, it's already in stage 4. This one broke down into stage 4 back around this area here. So if you look on the weekly chart, you can see the stage 4 breakdown area as it came down through these areas of support here. There was multiple areas of support underneath the 30-week moving average. There was a broader structure initially, which you can see, which is still holding on to, but obviously the secondary structure that formed as it's started to make higher lows, but still below the 30-week moving average there. So this was our stage 4 breakdown area, and then it's been making a secondary base since, again with the up thrust at the top there. So potential, if the earnings are badly received, for a stage 4 continuation breakdown. However, we'll see if we get a positive reaction in this, then potentially we'd want to see this start to pop back to the upside here and get back above the 30-week moving average. If it can, then we'd want to see, obviously, this kind of behavior. Caterpillar also reporting tomorrow, I believe. So 28th, before the market open on this one tomorrow. So this is next up in the morning. If I zoom out on this one a little bit, you can see the broader. Go into that. See the broader structure that's been forming over the last 8 or 9 months or so. So we can see we had the initial thrust down, climax. Oh, wrong one. I've had a few thrusts to the upside and downside on this one. So some spring type action, and then it's run back to the top here. Attempted to break out, but failed with a significant bar here. So this one is looking a little bit on the dangerous side here at the moment. So if I come out of this and go to a weekly chart, you can see the stage 3 range that's been forming since the top up here. So this is our broader stage 3 range, and then the secondary base structure that's formed within that. So at the moment we've got a potential up thrust within the lower structure, and it's come back in. So if this starts to falter and get back below this 30-week moving average here, you see the 30-week moving average start to roll, then this could potentially drop off into a stage 4 decline. So obviously on the lookout for that one. So it depends on how the earnings go. So we've had a lot of gap type moves at the moment. So potentially here, if you had a 10 to 15% gap on this, it could actually drop it down to the low of the range here. So you could actually gap to the low of the range and into stage 4. So obviously a positive gap on the other side would potentially take it back into stage 2. So never rule out either at this point, but with the weak market at the moment and the poor reactions that we've seen in most of the stocks so far, except for Facebook today, it's looking more likely for a breakdown. But obviously we don't know what's going to happen until it happens. So the thing with earnings results is you're looking for reactions, you're not trying to anticipate. So wait for the reaction and then obviously make the move then. Friday we've got Exxon Mobil, I believe, and it's before the open on Friday. So this one very different to the other charts we've been looking at. It's obviously is one of the strongest groups in the market. So let me get a full quote up. I believe it is in integrated oil and gas. So this has been one of the top 5 groups in the RS table for the last 3 or 4 months at least. But obviously since the rest of the market started breaking down, and for a big part of the last year really. But you can see November, December time we started to make a move out in this one. This is obviously a large cap from the group. You can see this structure it's been forming since we've got a buying climax, automatic reaction, secondary testing here, and then further testing. So currently phase B of a base structure. Like a break to the downside in here would obviously be very negative, and could then potentially take it back down for a test at the 200-day moving average here. If we look at it on the weekly chart, you can see it's still in a strong stage 2 run, but as you can see on that daily time frame, we're obviously starting to make a base here. With the weakening market action at the moment, a lot of the strong RS groups have been taking a big hit at the moment. So this one, you can see, didn't get out of it. We had a big move for 3 days there, 12% move in 3 days, and gapped, and it's come back into the 21-day. So as I said, if it starts to break below this 50-day moving average in here, then potentially could turn into a short. So, but if it can hold up and then we start to see get a gap up big move up, and then it can tighten up at the top of the range, then potentially we'd be looking for a break to the upside. But right. And then reviewing a couple of the ones from earlier in the week. So I did a post on these yesterday, and over the last week or so, I've talked about them a couple of times. As obviously we saw the stage 4 breakdown in Google last week, and then yesterday's earnings results weren't received very well. It had a feeble move overnight, and then declined again today. So it's made a continuation move this week and is now into early stage 4. You can see the relative strength versus the S&P 500 remains well below the zero line here, which has been flattening out. So the zero line is this 52-week moving average of the stock versus the S&P 500. So once that starts to flatten out or starts to decline, so when you start to get this kind of flattening and then moving down, then obviously that's the best time to be on the short side. But if it's still rising and you get a move below it, then it often could be a rebound move back in the range. So you can see vast majority of the time when you're in stage 2, your relative strength line should be above and outperforming the S&P 500. If it's obviously below the zero line here, then you're underperforming the S&P 500, then that's generally an avoid. So at the moment, Google is in stage 4, early stage 4, and on an avoid. Microsoft also reported yesterday. So this one's a bit more interesting in terms of positionally. So had a pop today. So rallied up intraday. If we look at it on the 4-hour chart here, you can see this structure that it's been forming that looks like a potential distributional structure. We've got a local selling climax into an automatic rally, secondary test areas. Then we had some more testing at the lows, kept undercutting, so sign of weakness in there, rallies back up to the top of the range with an up thrust, and then tests. So potential up thrust after distribution here, started to break down, gap down again, then we've had a lower high, and then today's rally on the earnings, it gapped up. We had a 5% move today to close pretty much. You can see it gapped up a little bit more intraday, but then started to roll over. Volume was reasonably big, but you can see it's didn't overcome this area here, so potentially weak with a distributional looking structure at the moment. If it can overcome this short-term area here and then start to hold above here and start to move back up with a sign of strength and then hold out of the range, then obviously that would turn this into a spring type action, which obviously can happen from an earnings move. But at the moment, with the distributional look of it, we're more expecting a move to the downside. So that's what I'm looking for at the moment on that. So as I said, on the weekly chart here, it remains in stage 3 at the moment, but a break, if it does roll there and start to go down on that intraday chart, then this could potentially drop down into stage 4 here. So a break to the downside here would move it clearly into stage 4, and obviously on some stronger volume as well, ideally. Although a large cap stock like Microsoft, you don't tend to get that kind of volume. Right. Moving on.